Imagine, just for a moment, a digital asset so transformative and powerful that it sends shockwaves through the heart of global finance, ignites a technological arms race, and forces the world's most influential institutions, Wall Street giants, Silicon Valley titans, and nation-states themselves, to scramble for a stake. Now picture this. The core engine of this asset has just undergone a change so sweeping, so fundamental, that the ground rules themselves have shifted, possibly for good. Welcome to the dawn of a new Ethereum era, where code and capital fuse on a scale the world has never before witnessed, and where the fate of global finance hangs in the balance. Ethereum did not begin as a household name or a Wall Street darling. It was, at its inception, a bold bet and experiment. What if, its founders asked, you could automate trust itself? What if you could build digital contracts, smart contracts, that execute themselves without the need for courts or middlemen? What if a single open-source protocol could become the backbone for a borderless, programmable economy? These were questions that seemed almost fantastical a decade ago. Fast forward to today, and Ethereum has outgrown its origins as a playground for cryptographic tinkerers. It now stands shoulder to shoulder with the world's largest financial institutions, by value moved, and by innovation enabled. Over the past several years, the Ethereum network has been through a series of revolutions. The first seismic shift came with the merge, the historic upgrade that saw Ethereum transition from an energy-intensive proof-of-work model to a sustainable, eco-friendly proof-of-stake protocol. This wasn't just a technical tweak, it was a paradigm shift. By replacing miners with validators, Ethereum slashed its energy consumption by more than 99%, instantly making it one of the greenest major blockchains. But the merge was only the opening act. Enter EIP 1559, an upgrade that flipped the script on Ethereum's economic model. By introducing a mechanism that burns a portion of transaction fees, EIP 1559 began to make Ether, the network's native currency, progressively scarcer. Now every time someone pays to use Ethereum, a little bit of Ether disappears from circulation forever. This deflationary effect was unprecedented and instantly caught the attention of macro investors, who saw in Ether not just a utility token, but a potential store of value rivaling gold or even sovereign bonds. The impact of these changes cannot be overstated. Where once Ethereum's supply was theoretically infinite, it is now shrinking. And as any student of economics will tell you, when demand rises and supply falls, prices tend to react, sometimes explosively. Ethereum's journey from a speculative experiment to a foundational pillar of global finance is the story of this decade. Yet, this was still just the beginning. In May of 2025, the Ethereum network underwent the Pectra upgrade, which introduced 11 new features aimed at improving smart wallet functionality, scalability, and overall user experience. This was not merely another technical update. It was a clarion call to developers and institutions alike. Ethereum was ready for prime time, and the world began to take serious notice. Consider this. As of July, BlackRock's iShares Ethereum Trust, a behemoth in the world of exchange-traded funds, holds more than 1,510,000 Ether, an amount valued at close to $4 billion at current prices. To put that in perspective, this is more Ether than many entire countries have in their reserves. SharpLink Gaming, a major player in digital entertainment, has amassed 176,000 Ether, making it the largest publicly traded Ether holder. Bit Digital, a company better known for its Bitcoin mining, recently purchased 100,000 Ether, instantly becoming the second largest publicly traded Ether holder worldwide. But it's not just traditional companies piling in. The stablecoin market, which is largely built atop Ethereum, has soared to $228 billion in value, a surge of 17% since the start of the year. Stablecoins are the backbone of crypto trading and decentralized finance, acting as digital dollars that can be moved anywhere in seconds. Their explosive growth is both a testament to Ethereum's versatility and a harbinger of its growing importance in global money flows. The numbers are genuinely staggering. According to Glassnode, spot Ethereum ETFs saw inflows exceeding $1,100 million in June alone, a record-breaking figure. This is not retail speculation, this is institutional capital on the move. Sassel, one of the leading Ethereum analysts, observes that for the first time in history, institutional giants and corporate treasury departments are buying Ether at a scale never before witnessed. This is a sea change. It signals that Ethereum is no longer seen as a fringe technology or a speculative plaything, but as a credible asset class worthy of inclusion in the world's largest portfolios. And the market is responding in kind. In just 1 week, Ethereum's price climbed by nearly 20%, now trading close to $3,000. But perhaps more important than price is the underlying momentum. Ethereum's futures open interest reached $20 billion as of July 11th, indicating a tidal wave of sophisticated bets on its future. All the while, nearly 30% of the total Ether supply is now staked, locked away by validators earning rewards for securing the network. This means that almost 1 in every 3 Ether coins is off the market, further tightening supply at a time when demand is exploding. But here's where the story takes a dramatic turn. As the hype reaches fever pitch, the very success of Ethereum brings with it a new set of existential challenges. Experts warn that with great scale comes great vulnerability. The very factors that have propelled Ethereum to these heights, network effects, rapid innovation, and institutional adoption, could also sow the seeds of its downfall if not carefully managed. Scalability remains Ethereum's Achilles heel. As millions of users and thousands of applications pile onto the network, congestion and high fees threaten to erode its competitive edge. Leo Fan, a leading researcher at CISIC, cautions that unless Ethereum adopts specialized hardware for cryptographic operations, it risks falling behind a new wave of faster, cheaper blockchains. These so-called Ethereum killers, networks like Solana, Avalanche, and others, are aggressively pursuing hardware acceleration and innovative consensus mechanisms to outpace Ethereum on throughput and cost. Even as Ethereum's developers race to deliver future upgrades like Ethereum 3.0, the pressure is mounting. Regulatory uncertainty looms large. Governments around the world are scrambling to write the rules for digital assets. And the United States Congress is currently debating the Genius Act, a sweeping piece of legislation that could make or break the stablecoin ecosystem. If passed, the Genius Act would impose strict regulations on stablecoin issuers, potentially reshaping the entire landscape of decentralized finance. Given that stablecoins represent over $228 billion in value, the stakes could not be higher. Let's zoom out for a moment and consider the possible futures that lie ahead for Ethereum. One scenario sees Ethereum evolving into a true world reserve asset, used by nations, multinational corporations, and individuals alike as a neutral, programmable money. Imagine a future where Fortune 500 companies hold Ether on their balance sheets, where central banks use Ethereum's rails to move value across borders instantly, and where smart contracts automate everything from supply chains to insurance payouts. But there are alternative futures as well. If Ethereum stumbles, whether due to regulatory crackdowns, technological stagnation, or simple market preference, it could lose ground to nimble upstarts. Networks that offer greater speed, lower fees, or unique features might siphon off developers, users, and ultimately, value. Already we are witnessing a proliferation of Layer 2 solutions, protocols that settle transactions off the main Ethereum chain before bundling them back, thereby reducing congestion. While this has boosted scalability, it also fragments the ecosystem and introduces new security and composability challenges. There's also a wildcard in the form of zero-knowledge proofs, a technology that Ethereum's creator, Vitalik Buterin, hails as the core for the next decade. Zero-knowledge proofs promise to make transactions not only faster and more scalable, but also private. This could be Ethereum's trump card, enabling use cases that are simply impossible on public blockchains today. If Ethereum can successfully integrate zero-knowledge proof technology at scale, it could leapfrog the competition and cement its status as the backbone of the next-generation internet economy. But the challenges remain formidable. If hardware acceleration does not keep up with software innovation, we could witness a split ecosystem. The wealthiest users and institutions migrate to newer, high-speed platforms, while everyday users are priced out or left behind. This is the billion-dollar battleground that will define the next era of digital finance. So what does all this mean for you, the investor, the builder, the curious observer? The lesson is clear. Ethereum's trajectory is both exhilarating and fraught with risk. If you are contemplating an investment, it is vital to recognize that institutional flows are only one piece of the puzzle. Upgrades like Pectra, the evolution of Layer 2 solutions, and the adoption of zero-knowledge proofs are the engines humming under the hood. Astute observers will pay close attention not only to price action, but to the rate of staked Ether, the pace of ETF inflows, and the regulatory winds blowing from Washington to Brussels to Beijing. Let's not forget, too, that the Genius Act in the United States could dramatically reshape the stablecoin landscape. If stablecoin issuers are forced to comply with strict new rules, the $228 billion market for digital dollars could either solidify Ethereum's dominance or push users toward alternative platforms. This is why staying informed, agile, and diversified is more important than ever, just as the world's largest funds are doing now. Yet, the true significance of Ethereum transcends price charts and trading strategies. This is a story about the future of smart contracts, self-executing programs that can replace lawyers, brokers, and even some forms of government bureaucracy. It's about decentralized finance, or DeFi, which now moves hundreds of billions of dollars without banks or intermediaries. It's about digital identity, where users control their own credentials and privacy online. As Michael van de Poppe, a widely respected analyst, notes, Ether continues to show strength, up 50% against Bitcoin since April. This is not just another bull run. It's a technological arms race, with consequences that will ripple across industries and continents. Can Ethereum overcome its growing pains? Or will its very success sow the seeds of new challenges? The answer, at this juncture, is both thrilling and uncertain. If Ethereum succeeds, it could become the backbone of a digital-first economy, transforming not just how money moves, but how trust itself is built and enforced worldwide. If it falters, the disruption will create new space for rivals and innovators, ensuring that the race for decentralized finance is far from over. There is, however, one secret that most people overlook. Ethereum's supply is more limited than ever. With nearly 30% of all Ether staked and major players locking up millions of tokens in ETFs and corporate treasuries, liquidity is drying up. Scarcity may become Ethereum's greatest strength, propelling prices even higher as demand surges. But it is a double-edged sword. If liquidity dries up too much, markets can become brittle and volatile, increasing the risk for everyone involved. To understand the magnitude of what's unfolding, consider this. Ethereum now processes more value in decentralized finance transactions than most national stock exchanges process in equities. It has become the settlement layer for the tokenized economy, where everything from real estate titles to art, music royalties to carbon credits is being digitized and traded. Governments are experimenting with issuing bonds and even central bank digital currencies on Ethereum-compatible chains. Enterprises are building private Layer 2 networks to streamline supply chains, automate compliance, and cut costs. The ambition is nothing less than to remake the plumbing of the global economy. But with ambition comes responsibility. Ethereum's developers, led by visionaries like Vitalik Buterin, are acutely aware of the need for robust governance. The upcoming Ethereum 3.0 upgrade promises to address long-standing scaling bottlenecks, improve user experience, and lay the groundwork for integrating advanced privacy technologies. However, the road ahead is fraught with technical, political, and economic landmines. Decentralization, the core ethos of Ethereum, sometimes clashes with the need for speed and efficiency. Striking the right balance will determine whether Ethereum remains the people's protocol or becomes a tool of the powerful. Meanwhile, competitors are not standing still. Solana, for instance, boasts transaction speeds and throughput that currently outpace Ethereum by orders of magnitude, albeit at the cost of greater centralization risks. Avalanche and other Layer 1 blockchains are aggressively courting developers with generous grants and technical support. Even Bitcoin is evolving, with new protocols being built on top to enable smart contracts and faster settlements. The arms race is real, and the outcome is far from predetermined. Yet, there are reasons for optimism. The Ethereum community has proven remarkably resilient and innovative. The rise of decentralized autonomous organizations, or DAOs, has democratized governance, allowing users to propose and vote on protocol upgrades. The explosion of NFT platforms has brought mainstream attention and new users into the fold, and the academic community is pushing the boundaries of what's possible with cryptography and distributed systems. For the average person, all this may sound like science fiction, but the implications are very real. Imagine a world where sending money across borders is as easy and cheap as sending an email, where insurance claims are paid out automatically when certain conditions are met, without any paperwork, where property rights are encoded in software, making fraud and disputes a thing of the past. This is the world Ethereum is building, a world that is still taking shape, but one that is coming into focus faster than most people realize. So what should you do as this story unfolds? First, stay curious and informed. The pace of change is dizzying, and fortunes will be made and lost in the coming years. Second, don't put all your eggs in one basket. Diversification remains the single most reliable strategy in times of rapid innovation and uncertainty. Third, engage with the technology. Whether by using a decentralized finance app, participating in a DAO, or simply following the latest developments, direct experience is the best teacher. In closing, Ethereum stands at a crossroads. It is both the poster child for the promise of blockchain technology and the test case for its limitations. The next chapter will be written not just by developers and investors, but by regulators, enterprises, and everyday users around the globe. The outcome is impossible to predict, but one thing is certain: the rules of the game have changed, and the stakes have never been higher. If you found this deep dive helpful, don't forget to smash that like button and subscribe for more high-impact explorations of global economics and technology. What do you think? Will Ethereum redefine finance and the internet, or will it be outflanked by the next wave of innovation? Share your thoughts in the comments, and let's shape the conversation together. The story of